So picture the corporate world right in the mid-1990s.
Right. The whole globalization craze.
Exactly. The Cold War is over. Borders are suddenly opening up. You've got these massive Western multinational corporations looking at a map of the globe, and they are, I mean, they're practically salivating.
Oh, yeah. Billions of untapped consumers. Places like India, China, Brazil.
Right. And these Western giants, they aren't just rolling in with a bunch of money. They are coming armed with what they think is like the ultimate absolute gospel of business strategy.
The textbook perfection.
Yeah, the textbook. I mean, if you went to a top-tier business school any time in the last 40 years, you know exactly what this gospel is.
Yeah.
It's focus on your core business.
Right.
Shrink your boundaries.
Yeah.
Cut the fat. Like, do one thing better than anyone else in the entire world and just outsource the rest of it.
Which, was treated as an absolute law of physics in the Western business world.
Totally.
Like, if you make software, you shouldn't be running a logistics fleet. If you manufacture cars, you have absolutely no business owning, like a textile mill. The belief was always that hyper-focus equals efficiency, and efficiency equals survival.
So these hyper-focused Western juggernauts, they charge into emerging markets, and they fully expect to just absolutely bulldoze the local competition.
Yeah, they thought it was going to be a bloodbath.
Right. They look at the local players, these massive, sprawling, family-run conglomerates that dabble in, like, everything. Telecommunications, real estate, manufacturing chemicals, all under one roof.
The absolute opposite of focus.
Exactly. And the Western CEOs, they laugh. They look at them and see these bloated, inefficient dinosaurs. Yeah. But then something completely jarring happens, like a total slap in the face to Western logic.
Yeah, the Western giants start failing.
Miserably. The mortality rate is just staggering.
It was a massacre.
Meanwhile, those local, quote-unquote, inefficient dinosaurs, they don't just survive. They completely dominate.
And that right there is the massive paradigm shift. It completely broke the conventional wisdom of the time because the immediate reaction from Western analysts was to assume foul play.
Oh, sure. They just assumed it was cheating.
Right. They assumed these local conglomerates were only surviving because of crony capitalism or, government protectionism, deep-seated corruption. Because according to their Western models, there is no mathematical way a company making both microchips and cement could outcompete a hyper-focused multinational. It shouldn't be possible.
Right. And honestly, if you're looking at this bloated family empire that has a monopoly on practically everything in a developing country, corruption is the easiest assumption to make.
It's the lazy answer.
Right. You naturally wonder, are we really calling these sprawling empires efficient? Or are they just rigging the game? But the data, and this is what we're going to get into today, when you actually strip away the storytelling and look at the raw numbers, it proves something entirely different.
Completely different.
It proves their dominance is structural. Like, it's rooted in the fundamental underlying mechanics of the market itself.
And that is exactly what our mission is for this deep dive. We are looking at a landmark, brutally rigorous study conducted by two Harvard Business School professors, Tarun Khanna and Krishna Palepu.
Absolute legends in this space.
Yeah, they published this in the Journal of Finance back in the year 2000, and it still remains one of the most authoritative, just eye-opening investigations into how global business actually works.
And what I love is that they didn't rely on like a handful of convenient case studies or some anecdotal success stories.
No, not at all.
They went deep into the microcapillaries of an emerging economy. They analyzed the financial and stock market data of 1,309 real companies.
Which is an insane sample size for this kind of depth.
It's huge.
Yeah.
Because they wanted to answer a really dangerous question. Are these massive conglomerates actual value creators, or are they just parasites? So, if you're listening to this right now, whether you're an entrepreneur, an investor, or just someone trying to understand how the global economy actually functions, prepare to throw your old assumptions out the window.
Seriously, throw them out.
By the end of our conversation today, you're going to understand why staying in your lane can actually be a fatal mistake, depending entirely on, what road you're driving on.
Well, to really grasp the magnitude of what Khanna and Palepu discovered, we have to start with the baseline reality of Western finance, which is a concept known as the diversification discount.
Okay, let's break that down.
So in a developed market like the U.S., if a publicly traded company decides to manufacture both automobiles and artisan cheese.
Cars and cheese, got it.
Yeah, cars and cheese. Wall Street will severely punish its stock price.
Because investors look at that and think, you have absolutely no idea what you're doing.
Right. Like you're a car company taking capital that should be used for automotive R&D and you're funneling it into dairy production.
It's a completely inefficient allocation of capital. And the internal management becomes a total mess because, a guy who knows how to sell sedans doesn't know how to price Gouda.
Precisely. So the market applies a massive discount to your overall valuation. They believe those two businesses would operate much more efficiently if they were just split into separate, focused companies.
Right, that's just Finance 101.
Exactly. It's heavily documented. But when Khanna and Palepu turned their analytical lens toward emerging markets, specifically India in the early 1990s, they found a complete inversion.
A total 180.
Yeah. That exact same diversification, that car and cheese model, it didn't result in a discount. It actually became an invincible shield.
Which, begs the question, what exactly are they shielding themselves from? Why does a strategy that completely destroys value in Chicago suddenly create immense value in Mumbai?
It all comes down to a concept the researchers call institutional voids.
Institutional voids. Okay.
Think about the environment surrounding a business in a developed economy like the U.S. There is this massive, highly sophisticated, totally invisible infrastructure that exists just to support commercial activity.
It's like the air we breathe.
Yeah.
A business owner in New York doesn't even think about it. It's just always there.
Exactly.
Like if you have a brilliant idea but you have no money,
Yeah.
there is a sprawling venture capital ecosystem just ready to fund you.
Right. And if you need a specialized supply chain manager, there are dedicated headhunting firms, there are business schools constantly churning out certified talent.
And crucially, there is trust.
Yeah.
Enforced by external institutions. If you need to figure out the financial health of a partner, you have the SEC ensuring transparent disclosures. You have independent auditors. You have credit rating agencies.
Yeah, and if a supplier breaches a contract, you have a predictable, enforceable legal system to make you whole.
You just sue them.
Exactly. The Western firm relies on this institutional air to survive. It can afford to be incredibly narrow and hyper-focused on making the absolute best product, because it can easily and cheaply outsource every other function to this hyper-efficient external market.
But when you drop that exact same firm into an emerging market, suddenly there's no air.
None.
Those intermediate institutions, they simply don't exist yet.
Yeah.
Or they're severely compromised. You have massive information asymmetry. You don't have an army of financial analysts meticulously tracking every industry.
Right. The researchers laid this out quite starkly by comparing the institutional frameworks. Look at the legal system. In the U.S., liability laws are strict. Court rulings are highly predictable. But in India, during the period of the study, the courts were notoriously backlogged, unpredictable. Relying on a legal contract to protect your business was a massive gamble.
It's basically a coin toss.
Yeah. And look at the labor market. While the U.S. had a surplus of ready-made management talent with certified MBA skills, India faced a severe scarcity of trained executives. Workers were heavily unionized and inflexible, meaning you couldn't just, fire and hire at will to adapt to market changes.
Think about it like taking a Formula One car off-road.
Oh, that's a great analogy.
Right. You take this beautifully engineered, hyper-focused Western firm, that's the F1 car,
Yeah.
and it is built to achieve maximum speed on a perfectly paved track, which is the U.S. market.
Right.
The paved road represents the reliable courts. The pit crew represents the headhunters. The high-octane fuel is the venture capital. But if you take that F1 car and drop it into a jungle, an emerging market where there are no roads, no mechanics, and no gas stations.
It breaks down instantly.
Instantly. It doesn't matter how great the engine is. Its specialized, slick tires are completely useless in the mud.
That is a phenomenal way to visualize it. And in that environment, the local conglomerate, it isn't a sleek race car. It is a massive, heavily armored tank.
Yeah.
Right. It's slower on a straightaway, absolutely. But it doesn't need a paved road because it brings its own treads. It carries its own fuel. It has its own mechanics living inside the armor. In the jungle, the tank is going to outlast the F1 car every single time.
Because it has to build the infrastructure as it moves. It has to train its own managers from scratch because there are no external business schools. It has to rely on its own family reputation to secure loans because there are no credit rating agencies. It literally has to substitute for the missing market.
Exactly. It becomes the market. And this isn't just an anecdotal observation. It aligns perfectly with the transaction cost theory pioneered by economists like Ronald Coase and Oliver Williamson, which Khanna and Palepu really highlight here.
We'll definitely dig into Coase later because that completely flips the script.
Oh, for sure. But the main takeaway is that the optimal structure of a firm isn't some universal constant. It is entirely dependent on its institutional context. In a market riddled with these voids, The most profitable approach is to operate as a large, diversified business group that acts as its own intermediary.
So logically, okay, we understand why the tank survives while the F1 car just sinks in the mud. But the researchers didn't want to just theorize about survival. They wanted to measure actual hard performance. How well are these massive conglomerates performing against independent focused companies operating in that exact same jungle?
Right. To find the undeniable truth, they went straight to the ultimate arena, the Bombay Stock Exchange in 1993.
The perfect laboratory.
It really was. India had a long history of these massive business groups, which provided a huge sample size for statistical analysis. Plus, unlike some other emerging markets, Indian firms generally belong to only one group, which made categorizing them very clean.
There wasn't a bunch of messy overlap.
Exactly. And despite all the institutional voids, India had inherited British accounting standards. So the financial data was actually quite robust.
So they pull the records for 1,309 private sector firms listed on the exchange. And this is what makes this study so bulletproof. They aren't cherry-picking 5 successful companies and writing a pop business book about them.
No, they're looking at the entire battlefield.
And they split these 309 gladiators into 2 distinct camps. On one side, you have 655 firms that are members of massive diversified family business groups. These are the conglomerates, the tanks.
Right.
And on the other side, you have 654 independent standalone firms, the focused players trying to navigate the jungle on their own.
It is an incredibly balanced split in terms of just the sheer numbers. But when you look at the physical scale of these entities, the disparity is suffocating.
It's completely lopsided.
Oh, totally. The average independent firm in their sample had assets of around 281 million rupees.
Which sounds like a lot until you look at the group-affiliated firms.
Exactly. The average group-affiliated firm had assets of 1.035 billion rupees. They were nearly 4 times larger than their independent counterparts.
Wow.
And sales figures mirrored this dominance, averaging 848 million rupees for the group affiliates compared to just 208 million for the independents. They're also significantly older, deeply entrenched in the economy, with an average age of 24 years compared to 15 years for the standalone firms.
Okay, so if we apply standard Western economic theory to these numbers, what should we expect? We have these massive 24-year-old billion rupee beasts. They're involved in a dozen different industries. They should be drowning in bureaucracy.
We should be.
They should be incredibly sluggish, highly unprofitable, and the stock market should be aggressively discounting their value because they lack focus.
That is precisely what the textbook dictates. The sheer weight of coordinating so many disparate businesses under one corporate umbrella should destroy their profit margins.
But when they ran the numbers, they uncovered a jarring reality, another slap in the face.
Yeah.
Their profitability measured by return on assets, or ROA, was virtually identical to the nimble, focused firms.
Yep.
The group affiliates had a mean ROA of 8.68%, and the independents were sitting at 8.38%. It's basically a statistical tie.
And the revelation becomes even more profound when you look at market valuation. The researchers used a metric called Tobin's Q.
Let's explain Tobin's Q for the listener, just briefly, because it's a brilliant metric for this. It basically measures the market value of a company like what investors think it's worth, divided by the replacement cost of its actual physical assets.
Yeah. Right.
So if a company's Tobin's Q is greater than 1, it means the market believes the company's management, its brand, its strategy, its invisible assets are creating value beyond just the brick-and-mortar factories it owns.
Exactly. It's a measure of how efficiently the market believes the company will use its resources in the future. And when they calculated the Tobin's Q for all 13,309 firms, the median valuation for the bloated, diversified group affiliates actually exceeded the median valuation for the nimble, focused independent firms.
Which is just mind-bending. The market's looking at a company doing 10 different things and saying, yes, we value you more than the company doing just one thing perfectly. How is a dinosaur keeping pace with, and even outrunning, the raptor?
Well, that was the mystery that Khanna and Palepu needed to solve, and they realized pretty quickly that simply classifying a firm as a group affiliate was way too blunt of an instrument.
Right, because not all groups are the same.
Exactly. Some groups only dabbled in a couple of industries, while others spanned across 15. They needed to measure the intensity of the diversification. So they mapped out the market valuation against the exact number of different industries a business group operated in.
And this is where the data completely breaks away from a simple linear narrative.
Yeah.
Because you'd think, based on the survival logic we just talked about, That if diversification is good, then more diversification is always better.
Right.
A straight line up on the graph.
That's the logical assumption. But they didn't find a straight line. They found a profound, almost terrifying U-shaped curve.
A curve of life and death.
It really is. Let's break this U-shaped curve down into its 3 distinct phases, because this is the absolute core of how emerging markets function. First, at the bottom left of the curve, you have the vast majority of the groups. Let's call them the losers.
Okay, the losers. These are the groups operating in 1 to 4 different industries. And what's wild to me is that they make up a massive 71% of all the business groups in the entire study.
Yeah, the vast majority.
The vast majority of these family empires are actually playing in this shallow end of the pool.
And their performance perfectly reflects that shallow commitment. Their mean Tobin's Q, their market valuation, was 1.405. Now compare that to the focused independent firms, which sat at 1.382.
So no real difference.
Statistically speaking, there is no significant difference. These moderately diversified groups are gaining absolutely no special advantage. They are dealing with all the headaches of running multiple businesses, but they aren't reaping any outsized rewards.
Then there's a group tries to expand further. As they push into 5, 6, or 7 different industries, they don't just stagnate, they fall off a cliff.
Yeah.
They enter what is essentially a death zone for corporate strategy.
Oh, this intermediate zone is brutal. The groups operating in 5 to 7 industries had the absolute worst market valuations in the entire dataset.
Worse than the independents.
Way worse. Their mean Tobin's Q plummeted to a dismal 1.255. Remember, the independent-focused firms are hovering around 1.32 to 1.38. So these middle-tier conglomerates are actually destroying value. The market is actively punishing them.
If you think about it, this is perfectly analogous to middle child syndrome in the business world. Like, why does this death zone exist? Because building those private internal institutions we talked about, the internal management training academies, the robust legal departments, the massive political lobbying arms, it requires astronomical fixed costs.
Right.
It's like deciding to build a private highway system just for your company's trucks.
It's an enormous capital expenditure. And if you are only operating in 5 or 6 industries, you are absorbing all the bloated overhead costs of a massive corporate headquarters. But you do not have enough total revenue or enough diverse product lines to spread those costs out effectively.
You're stuck in the middle. You're too big and bureaucratic to be as agile as an independent firm, but you don't have the sheer scale to dominate the landscape. You are carrying all the heavy armor of the tank, but you haven't bought the big guns yet. You're just a slow, expensive target.
That is the tragedy of the middle-tier group. They are paying the tax of institutional voids, but they haven't achieved the scale to become the government that actually collects the revenue.
Well, that's a good way to put it.
But then we look at the extreme right side of the U-shaped curve. Once a group survives the death zone and expands into 8, 9, 10 or more industries, the curve violently spikes upward.
The apex predators.
Precisely. These are the highly diversified giants. They represent only 10% of the groups in the sample, but their economic footprint is massive. They control nearly 19% of all the sample assets.
And when you look at their valuation, it completely shatters the Western models. Their mean Tobin's Q skyrockets to 1.655.
Yep.
They aren't just beating the middle-tier groups. They are absolutely crushing the focused independent firms. The market is paying a massive premium for extreme diversification.
Because once you cross that threshold, once your empire is vast enough, the economics of scale completely take over. The massive fixed cost of your internal training academy is now amortized across 10 different massive companies. The political influence you bought to protect your textile mill, it now effortlessly protects your new software division at zero marginal cost.
You have effectively replaced the missing external market with your own hyper-efficient internal ecosystem.
Exactly.
But I imagine listeners right now are thinking, hold on, is this actually causation or is it just correlation?
Right, the classic skepticism.
Yeah. Maybe these apex predators are just the oldest families with the deepest pockets and their diversification is just a symptom of them already being rich. Or maybe they just got lucky and happened to buy into the booming tech and pharmaceutical sectors in the 90s while the focused firms were stuck making typewriters.
And the researchers anticipated exactly that skepticism. They didn't just present the raw averages and call it a day. They subjected this U-shaped curve to some of the most ruthless statistical stress testing possible. They built multivariable regression models to systematically strip away all the noise.
So they essentially built a mathematical filter. They said, okay, let's pretend all these companies are the exact same age. Let's pretend they're all the exact same size. Let's even use industry variables to pretend they're all operating in the exact same economic sector.
Right.
They wanted to isolate just one single variable, the scope of the empire.
Exactly. They controlled for firm size, firm age, and included 14 different industry controls to neutralize the effect of being in a quote-unquote hot sector. And after washing away all of those compounding factors, the result was ironclad.
It held up.
It held up perfectly. The U-shaped curve remained statistically significant at the 5% level. The negative coefficient for the initial diversification, meaning the death zone, and the positive coefficient for the extreme diversification, the squared term in their math, it all held true.
That is a total inversion of everything we thought we knew. The extreme diversification itself is the superpower. It's not just a byproduct of being old or big. The act of spanning across a dozen industries is the mechanism of survival.
It is the mechanism, yes.
So the obvious next question is, what does this superpower look like on the ground? How does a giant conglomerate physically use this breadth to crush an independent competitor?
Well, Khanna and Palepu identified several specific mechanisms, but two of them really stand out as absolute game changers. The first is a monopoly on international capital,
Which, in an emerging market in the 1990s, is the most precious resource on Earth. The domestic banks don't have enough money, and local consumers don't have enough savings. You desperately need foreign dollars to grow.
But imagine you are a portfolio manager in New York or London in 1993. You want to invest in India's growth story. You look at an independent, focused Indian software company. They have great margins. But you also see a chaotic legal system, rampant bureaucratic corruption, and zero financial transparency. You are terrified that if you wire them $10 million, the money will just vanish, and you will have absolutely no legal recourse.
It's a black box. The information asymmetry is paralyzing. You want the returns, but the risk of total loss is just too high.
So how do local companies bridge that trust gap? In the 90s, one of the primary ways was issuing global depository receipts, or GDRs.
Ah, GDRs.
This is essentially a mechanism that allows a foreign company's stock to be traded on Western exchanges. But it requires intense financial audits, massive roadshows in Western financial capitals, and millions of dollars in underwriting fees by major investment banks.
Right. An independent firm, no matter how good its product is, simply cannot afford the upfront costs of a GDR. Nor do they have the brand recognition to convince a London banker to underwrite them in the first place.
And the data perfectly reflects that reality. The researchers found that an overwhelming 83% of the companies issuing GDRs were affiliated with business groups.
83%.
Yeah, the independent firms were practically locked out of the global capital markets.
That isn't just an advantage. That is a total monopoly on the oxygen supply of business.
Furthermore, they looked at the behavior of international equity analysts. These are the people whose entire job is to decipher these markets and tell Western funds where to put their money.
Right.
These analysts completely ignored the standalone firms. Group-affiliated companies were covered by an average of almost 2 foreign analysts each, while unaffiliated firms barely averaged 1.
Because the analysts don't have the time or resources to investigate 100 tiny, opaque, independent firms. They follow the massive conglomerates because the conglomerate have a century-long track record. The family name, whether it's Tata, Birla, or Ambani, has essentially become a substitute for the country's missing legal infrastructure.
That is exactly it. The group's reputation is their collateral. If an independent firm defrauds a Western investor, they might get away with it because the local courts are slow. But if a Tata Group company defrauds an investor, the global markets will immediately punish the entire Tata empire, all of its diverse holdings.
The family cannot afford to burn their reputation, so they self-police their subsidiaries.
Right. Foreign investors know this, so they funnel all their capital exclusively to the conglomerates.
Which brings us to the second secret weapon, which is just as devastating. Technology and joint ventures. Say you are a massive American telecommunications giant, and you want to lay fiber optic cable across India.
Okay.
You have the world's best technology, but you don't know the first thing about acquiring land permits across 20 different Indian states, or dealing with local labor unions, or navigating the national telecommunications bureaucracy.
You need a local partner.
Exactly. And who are you going to choose? Are you going to partner with a 5-year-old independent firm that might get crushed by a sudden regulatory change? No. You are going to seek out the most powerful, politically connected, broadly diversified empire in the country.
The researchers actually quantified this. They looked at the top 50 group affiliates and the top 50 independent firms. Only 34% of the independent firms had managed to secure a foreign joint venture. But for the group affiliates, 50% of them had secured these lucrative partnerships.
Wow.
And it gets even more extreme. When you look at those apex predators, the supergroups operating in more than 10 industries, a staggering 60% of them had locked down foreign joint ventures.
It makes perfect economic sense. The foreign giant trades its cutting-edge technology for the local conglomerate's ability to navigate the institutional void. The conglomerate can guarantee property rights and enforce contracts internally using its massive social and political influence far more effectively than any local judge ever could.
Right.
Think about it like a VIP nightclub.
Okay, I like this.
The emerging market is this chaotic, extremely lucrative club. It's packed, the music is loud, and there's a lot of money to be made. But it's rough inside. The foreign capital and the foreign tech companies are standing out on the sidewalk. They want to go in, but they don't know the rules, they don't know the local players, and quite frankly, they're afraid of getting robbed in the dark.
So they look for a guide.
Exactly. And the massive business group isn't just a guide. They are the giant, widely feared bouncer at the door. The bouncer steps outside, grabs the foreign investor by the hand, walks them straight through the chaos, past the line, right to the best table in the house, and announces to the room, he's with me.
That handshake, that implicit guarantee of safety, is priceless.
It is worth billions because the local independent firm, who may be making a vastly superior local product, is fighting a ground war. Meanwhile, the conglomerate just walked through the front door with a Western tech giant, armed with billions in global capital and patented technology. It is a complete dimensional strike.
At a dimensional strike, yes.
The independent firm simply cannot compete against an opponent wielding global resources in a local arena.
It really paints a picture of an almost impenetrable fortress. But it's crucial we address the enormous skepticism that Western economists harbored toward these conglomerates at the time. Because if you read the literature from the 1980s and 90s, critics absolutely hated these groups.
Oh, they despise them.
They viewed them as parasitic black boxes that destroyed value on a macroeconomic level.
Right. The prevailing theory was that these families were running inefficient internal capital markets. The assumption was that they were playing a massive shell game.
Yes.
Let's say the conglomerate has a highly profitable software division, but they also own a legacy textile mill that is bleeding cash. The Western critics assumed the family was secretly siphoning the profits from the software winner and illegally pumping it into the textile loser just to keep their empire artificially inflated.
That's a very serious accusation, because if it's true, it means the conglomerate is destroying capital that could have been used for innovation. So Khanna and Palepu put this bias under the microscope. They tested it empirically by measuring the investment cash flow sensitivity of both group affiliates and independent firms.
Okay, how does that metric actually work in practice?
Essentially, it measures how heavily a company's decision to invest in new projects relies on its own internally generated cash. If the slush fund theory was true, you would expect a failing group-affiliated company to keep investing heavily despite having no cash flow because it's being bailed out by its sibling companies.
Right.
Conversely, a highly profitable group company might invest very little because its cash is being stolen by the parent group.
So they graphed this sensitivity for the independent firms and then graphed it for the conglomerates. And what did they find?
The curves were absolutely identical.
A total debunking.
Completely. There was absolutely no statistical difference in how these two types of firms funded their investments. The researchers found zero evidence that the conglomerates were using internal capital markets to prop up dying businesses or starve winning ones.
Wow.
The group affiliates were holding their individual companies accountable to the market just as rigorously as the standalone firms were.
So they aren't socialist slush funds. The software company reinvests its own profits, and the textile mill is forced to sink or swim on its own merits.
Exactly.
You know, this actually brings up a huge point of confusion for a lot of people who study global business.
Yeah.
When we talk about massive multi-industry empires, everyone immediately thinks of the Japanese Keiretsu system or the South Korean chaebols.
Oh, no.
Are these Indian business groups just the same thing with a different name?
Structurally, they are profoundly different, and it's a vital distinction. A Japanese keiretsu, like Mitsubishi or Sumitomo, is historically built around a massive central main bank.
Right.
That bank sits at the center of the web, funneling loans to all the member companies and using those deep credit ties to orchestrate the group's overall strategy. The bank is essentially the puppet master.
But in India, that model was literally illegal. The regulators strictly forbade business groups from owning dedicated captive banks.
Exactly. They couldn't just print loans for themselves. These Indian group affiliates are legally separate entities. They are publicly traded on the stock exchange. They have to publish their own independent financial statements. And most importantly, their management teams are legally responsible to their own shareholders, not just to the family patriarch.
So if they don't share a central bank, and they aren't shuffling cash under the table, what is the actual glue holding this massive empire together?
The glue is much lighter touch, but incredibly strong. It's interlocking board members, shared management training programs, centralized political lobbying, and the overarching umbrella of the family brand reputation. The group headquarters acts more like an elite consulting and recruiting hub rather than a central bank dictating financial terms.
Which naturally brings us to the topic of who actually owns these companies. The researchers looked closely at the ownership structures, specifically insider ownership, meaning the percentage of shares held by the founding family and their affiliated directors.
Yes, and the disparity was massive. Insider ownership in group-affiliated firms averaged a highly concentrated 31.9%. In contrast, the independent firms only had an average insider ownership of 20.8%.
Now, if you crack open any standard corporate governance textbook written in the US or the UK, it will flash massive red warning lights at that statistic.
Oh, sirens would be going off.
Right. The textbook says that if a founding family controls 32% of a public company, it is a disaster waiting to happen. They have enough voting power to entrench themselves, ignore the minority shareholders, and extract private benefits, like paying themselves massive salaries or making sweetheart deals with other family-owned shell companies.
That is the classic agency problem argument. It's heavily cited in papers by McConnell and Surveys in the early 90s. But again, context is everything.
Right.
When Khanna and Palepu ran the regressions on the Indian data, they didn't find that this concentrated ownership was destroying value. They found a statistically significant positive correlation between high insider ownership and corporate performance.
It actually made the companies better. How is that possible?
You have to look at the institutional void again. In the U.S., if a CEO gets lazy or incompetent, the market punishes them. The stock price drops, and a corporate raider launches a hostile takeover, fires the CEO, and restructures the company. The market for corporate control keeps management terrified and efficient.
But in an emerging market, there is no market for corporate control. Hostile takeovers are practically impossible due to regulations and lack of financing.
Exactly. Furthermore, the legal system won't punish a CEO for mild incompetence, and financial disclosures are too murky for outside investors to even realize the company's being mismanaged until it's too late.
So if there is no external threat of a hostile takeover to keep the management sharp, what stops the executives from just playing golf 5 days a week and letting the company rot?
A powerful, highly concentrated family owner watching them like a hawk.
The family acts as the ultimate enforcer.
Precisely. Because the family owns 32% of the company, their own personal wealth is entirely tied to the firm's performance. They internalize the massive cost of monitoring the management team. What Western textbooks decry as exploitative family control, the emerging market relies upon as its absolute primary mechanism for corporate governance.
Wow.
The family is the only entity with both the financial incentive and the structural power to fire a bad manager.
This entire deep dive is just a relentless dismantling of traditional economic theory. We're seeing a total inversion of reality. Diversification, normally a weakness, becomes a superpower. Concentrated family ownership, normally a red flag, becomes the ultimate shield against management bloat. We are looking at a fundamentally different species of capitalism.
We really are.
Which means it is time to bring this all together and look at the grand architecture of what is really happening. To do that, we have to bring in one of the most important economic thinkers of the 20th century.
We are talking about Ronald Coase.
Yes. Coase won the Nobel Prize for an incredibly elegant paper he published back in 1937 titled The Nature of the Firm. He asked a question that is so basic, most economists never even thought to ask it. Why do companies even exist?
It's a profound question.
Right. If free markets are so perfectly efficient at pricing goods and services, why doesn't every single person just act as an independent contractor, buying and selling their labor and materials on the open market every single day? Why do we organize into these hierarchical bureaucratic structures called corporations?
Coase's answer was both simple and revolutionary: transaction costs.
Let's break down exactly what a transaction cost is for the listener.
Using the open market is not free. There is a cost to finding a trustworthy supplier. There is a cost to negotiating a price. There is a massive cost to hiring lawyers to draft a watertight contract, and an even bigger cost to enforcing that contract if the supplier tries to cheat you.
There are costs to protecting your intellectual property from being stolen by contractors.
Right. All of these frictions are transaction costs. Coase argued that a firm will naturally expand hiring employees and building internal departments, right up to the point where the cost of managing that internal bureaucracy becomes more expensive than simply dealing with the external market.
So let's map Coase's Nobel Prize-winning theory onto everything we've discussed about emerging markets today. In a developed economy like the United States, the external transaction costs are incredibly low. The SEC ensures you don't get defrauded. The courts ensure contracts are honored cheaply and quickly. The specialized headhunters find you the exact talent you need in days.
Because the market is so highly efficient, the rational move for a U.S. firm is to shrink its boundaries. It fires its internal accounting department and hires an external firm. It sells its logistics fleet and outsources delivery to FedEx. It focuses entirely on its core competency because the external market can handle everything else cheaper and better.
But in an emerging market, the jungle, the external transaction costs aren't just high. They are astronomical. Sometimes they approach infinity because the specific market you need literally does not exist.
Exactly.
You cannot buy trust on the open market in 1993 India.
Yeah.
You cannot just hire a third-party logistics firm that won't get shaken down by local bureaucrats.
So according to Coase's theorem, if the external transaction costs are near infinity, the firm has no choice but to stretch its boundaries outward. It must absorb those external functions internally. If it can't find a reliable bank, it uses its family reputation to secure foreign capital.
Right.
If it can't find trained managers, it builds a massive internal university to train them. It can't just participate in the market. It must swallow the market.
It must swallow the market.
Yep.
That is the grand synthesis of this entire phenomenon. These apex predators, the massive sprawling empires that operate in 15 different industries, they aren't actually in the business of making textiles or software or steel. They are fundamentally in the business of manufacturing institutions.
They are building the infrastructure that the state failed to provide. And they're using their own capital, their own reputation, and their own flesh to build the bridges over those societal gaps.
Are they monopolistic?
Yeah.
Yes. Do they wield terrifying political power? Absolutely. But the rigorous mathematical data proves that they are not just parasites sucking the life out of the economy. They are a necessary, vital, historical stepping stone.
Until a developing nation manages to build its own robust public institutions, until it has reliable courts, transparent capital markets, and a deeply educated workforce, these private family empires are the only efficient vehicle capable of connecting local labor to global capital and cutting-edge technology.
Right. If you prematurely destroy the conglomerates in the name of market efficiency, the entire ecosystem collapses. The independent firms don't magically rise up, they just sink into the mud because the institutional void swallows them.
Which is precisely the tragic mistake so many Western multinationals made in the 1990s. They arrogantly marched into these countries, stubbornly clinging to their narrow, hyper-focused boundaries, completely blind to the transaction costs that were about to bleed them dry.
Let's summarize this mind-bending journey. We started with the absolute arrogance of the Western MBA textbook, the unshakable belief that focus is the only way to survive. We walked through the graveyard of failed foreign giants who tried to drive their F1 cars through a jungle. We looked at the brutal, unassailable data of 3,309 firms fighting it out on the Bombay Stock Exchange.
We uncovered the terrifying U-shaped curve of survival, proving that half measures will kill you. You either stay small and local, or you push through the agonizing death zone to become a highly diversified apex predator.
We exposed their secret weapons, their absolute monopoly on foreign trust, and their ability to act as the exclusive bouncers for global tech giants.
And finally, we used Ronald Coase to understand the fundamental architecture of it all. In a profoundly broken system, the most efficient and rational thing a business can do is to become the system itself.
But I want to leave you, the listener, with a chilling, forward-looking thought. Khanna and Palepu published this brilliant dissection of emerging markets back in the year 2000. They were looking at India in the early 90s. But I want you to look at the world we live in right now.
It's changing fast.
Look at the state of the global economy today. Global supply chains are fracturing. Geopolitics is tearing international trust apart. And most importantly, massive technological shifts, like the explosion of artificial intelligence, are creating entirely new, unregulated frontiers where the traditional rules do not apply.
It is a fascinating parallel. We are seeing severe regulatory lag.
Exactly. Aren't we seeing new institutional voids opening up right beneath our feet, right here in the developed West? Look at the megatech empires of today. Look at Amazon, Google, Apple, Microsoft. They are absolutely not staying in their lanes.
No, they are everywhere.
They are operating across a dizzying array of industries. They are in cloud computing, Hollywood entertainment, global logistics, consumer hardware, artificial intelligence, autonomous vehicles, and healthcare.
They're swallowing the market.
They are building their own private ecosystems. They dictate their own rules, govern their own digital marketplaces, and lay their own sub-oceanic fiber optic cables. Because the traditional external markets and the traditional governments simply cannot keep pace with the speed of their reality.
It's the same dynamic.
Are we right now in the 21st century witnessing the triumphant return of the massive diversified business group? Are these tech giants the new digital apex predators, surviving and dominating because our traditional institutions are failing us once again? Think about that the next time a consultant points at a chart and tells you that a company really needs to stick to its core business because the X-ray machine might just be broken again and the jungle is back.